Hello, everybody. Welcome. Welcome. Thank you for listening. Hope you find this presentation instructive. I expect my presentation to last about 25 minutes. I don't want to keep you from dinner. I don't want to keep you from my dinner, which is probably your limit to how much you can listen to me talk nonstop anyway. At this point, at the end, we'll open up to your questions, or you'll be able to reach out to me directly in the coming days, and please do with any follow-up questions. So with that, let's go to the presentation, 50 years, three bear markets. And I think the title sounds a little downbeat, but it is intended to be a confidence-inspiring refresh of economic history. We know that history does not predict the future, but as President Harry Truman said, the only thing new in the world is the history you don't know. So the presentation should reinforce our message that the markets are unpredictable, but ultimately very rewarding. However, the reward only comes to those that have a plan and stick with that plan. You kind of jumped ahead on me, Mary. Not to those who change course when the markets deliver one of their periodic downturns. So I intend to make 4 key points. The shares of America's finest companies experience frequent declines in price. Many of these declines have been quite significant. Despite these periodic setbacks, leading U.S. companies and really companies in the world have continued to grow their earnings and dividends strongly over time. Their share prices have overcome even the deepest declines, and usually more rapidly than we might have expected, and then gone on to new heights. So, looking over our attendee list, I can see that we are all, lucky or unlucky, to have been born before January 10th, 1973. So that means we've all lived through these 3 episodes in which the broad U.S. stock market went down by roughly half. The first one, I was in so let's go to that one first. Oh, I'm sorry, first half century. We're January 1973, October 74, when the S&P 500 was down 48%. March 2000 to October 2002, the dot-com bubble, when the S&P was down 49%. And then October 2007, March 2009, the S&P was off 57%. Each one of these declines were driven by very real, very different events that were happening at the time. And I would describe them more like class 5 hurricanes than mere summer thunderstorms. So let's go right to the first one, 1973-74. And that was when I was in high school. While I was a limited investor at that time, I really wasn't paying attention all that much. And these are the various things that were happening. Oil embargo, inflation explodes, recession, unemployment peaked at 9%, Watergate. So at that point, the decline was the largest since the Great Depression. And it was a crescendo of crises, economic, financial, and political chaos. The Arab oil embargo cut off oil supplies to the U.S. in October 1973. The price of oil quadrupled in 4 months. Following that, inflation exploded. Watergate, that became the greatest constitutional crisis in our history since the Civil War. And basically, at that time, it got worse every day for well over a year. From the time one of the Watergate conspirators blew the lid off the cover-up in the spring of 1973, until Nixon finally resigned in August 1974. We all remember him giving the victory, V for victory sign. All those sequence of events ending with that helicopter ride shattered investor psychology. It was a very tough time. Okay, on to the next exciting event. That was the dot-com bubble, March 2000 to October 2002. The S&P 500 was off 49%. The NASDAQ was down 80%. And this is the implosion of the dot-com bubble. There was a recession. There was Enron and the accounting scandals. And finally, there was 9/11, September 11, 2001. So the dot-com bubble was really the greatest stock market bubble in American history, before or since. And the sudden destruction of capital was not seen on a scale since 1929. Next came the terrorist attacks of 9/11, plunging us into a global war with an enemy we could not see. Calling it this generation's Pearl Harbor doesn't really begin to capture the horror of it, if only because it happened to our own soil, here in New York City, on our televisions in real time. We had friends and neighbors that had lost spouses and lost brothers and sisters. Finally, Enron, which Fortune magazine in its wisdom had dubbed America's most innovative company 6 years in a row, vaporized in the most spectacular accounting fraud ever. Quickly, several other large companies were similarly unmasked as having materially corrupted their accountants. Thus, even as the bear market gathered momentum and ferocity into 2002, suddenly investors completely lost faith in the numbers. Who could even say what any stock was really worth? I was only a few years into my career when that happened, and it was a very difficult, challenging time. Lastly, the subprime mortgage catastrophe of October 2007, March of 2009. The S&P was down 57%. It was a global financial crisis. It was the longest, deepest. Somewhere I lost my, can you guys, am I still on, as far as we can tell? Hopefully. Anyway, my screen popped out there for a second, guys. Sorry. Hopefully you're still getting me. It was the longest and deepest recession since the 1930s. Unemployment peaked at 10%. This was the big one. When the subprime mortgage crisis began unraveling and the equity market topped out, a full year before the Lehman bankruptcy, by which time the S&P was already down close to 25%. Then the thermonuclear meltdown really got going. In effect, the global credit system ceased to function. In 17 months, we experienced this generation's 1929 to 1932. So what can we learn from these three events? Simply that the death song of the panicking investor, this time is different, is always narrowly correct. Any crisis capable of taking the equity market down by half must be without precedent in some very real and specific ways. That's never the issue. We can agree things are different each time. The issue arises when the investor sings the next line of the death song. This time is different, and therefore we must bail out of our long-term planned portfolio and wait in cash for things to settle down, whatever that means. So let's look at some numbers to get some perspective on this. So this is the S&P 500 in 1972, at the end of 72, right before that first calamity. The index stood at 118. 50 years later, 12/31/22, the end of last year, it was at 38.40. It had gone up 32 times. What about earnings? Aggregate earnings of all the 500 companies in the S&P 500 at the end of 1972 were $6.17. Those earnings 50 years later had grown to $219. They had gone up 35 times. Clearly, earnings had even gone up more than the index. So why have stock prices risen so much over time? Because superior companies like those in the S&P 500 have increased their earnings. So why have earnings gone up so much? Well, there's a couple of reasons. One, not shown on the page, is population went up here and around the world. In the US, population went up 50%. But that's not the main reason. That's just a side thing. Really, it's about productivity growth and then innovation. So in 1972, The GDP per person was $26,000. Per person in 2022, that GDP per person had grown to $60,000, more than double. What about innovation? So innovation, 9 out of the 10 most valuable companies in the S&P 500 as of the end of 2022 did not exist in 1972. And we can think about now, Wall Street is talking about what's called the Magnificent Seven. That's the 7 largest companies in the S&P 500, all of which are very tech-oriented, although not necessarily in tech category. And let's see if I can name all 7. Amazon, Tesla, Meta/Facebook, NVIDIA, Google, missing 2. Microsoft. Mary's helping me. I can't remember. Earlier today, I got all 7. Now I'm only going up to 6. But anyway, those are the 7 largest companies in the S&P 500. They're called the Magnificent Seven by Wall Street. They generated something like 80% of the earnings in the S&P this year. None of them were in existence in 1972. I think Microsoft was started in 1975, if I'm not mistaken. Anyway, so that innovation those companies represent essentially is what has driven earnings and growth so much. Okay. We can go on to the next slide. What else? Dividends. Dividends have grown far ahead of inflation. We don't talk much about dividends. I think dividends right now are roughly 20% of the total return in the S&P. In the past, they might have been a lot higher. I think over time, the average is maybe 30%, but right now they're at about 20%. So what were the dividends in 1972? The aggregate dividends of the S&P 500 in 1972 were $3.19. The aggregate dividends in 2022 were $67, went up 21 times. And one of the nice things about dividends, you can think about it as interest. Well, interest doesn't go up with inflation. So the next one down is consumer price index. The value or the number on the consumer price index was 43 in 1972. Essentially, as the value of the currency decreased, inflation went up. That number stood at 297. So inflation went up 7 times during that time period. Obviously, dividends went up 3 times as fast. So it's a very good way to protect your purchasing power. What else? What is one of the big concerns investors have is, okay, Mark, I get that, but I don't have that long time period to work with, or I can't wait that long for my value of my investors to come back. So you can go to the next slide, Mary. So the question they have is, how long will it take me to break even if we have a downturn like that? So since the end of World War II, with dividends reinvested, what is the longest time to break even? And go ahead, Mary. And that is 5 years, 8 months. And that was August 2000 to April 2006. Now, understand we're talking about the S&P 500 here. Investing with us, you are invested in bonds as well. You're invested in emerging markets. You're invested in international. And for investors who were investing with me back then, I would say the time to break even was about 2 years, because we weren't all in the S&P. We were diversified. And the international markets did especially well during that time period. So it's one of the advantages of being diversified. But it's for the return you get over time, it's not that long. Okay, next slide. So this is a very important slide, and it's not intuitive. So as stock prices decline, it's important to remember price and value move in opposite directions. So when I say that, it's really, even now, me saying it, it's hard to wrap your brain around that. And what it means, if basically, if the price of a good goes down and you want that good, as the price goes down, you're more likely to buy it because there's more value for you. And if you can think about right now, shopping for Christmas, if you're a Christmas shopper, we are Christmas shoppers. So Black Friday is a good time to shop. Cyber Monday is a good time to shop for Christmas because the prices of everything have come down. So that's what we were doing. We're out there getting our Christmas gifts. And now when the stock market goes down, I can maybe every kind of downturn like this, maybe one person or two people across my whole book of clients comes to me and said, listen, I got 100,000, the prices are down, let's put it to work now. Nobody wants to do that, even though the value is much better than everybody's too fearful. So going to the next slide, this is what Wall Street says about that. The stock exchange is the only place where when they have a big sale, everyone runs out of the store. And that's certainly true, and it kind of speaks to our fear impulse in our brains. Next slide. So where does this all leave us? And this is a quote from Charlie Munger. Charlie Munger, with him and Warren Buffett together, they were partners. They're essentially together considered the two best investors of the last 50 years. And I'm going to give you the quote, then I'll tell you another story. So the quote is, if you're going to be in this game for the long haul, which is and I'll say only way to do it, you better be able to handle a 50% decline without fussing too much about it. Because if you can't handle that 50% decline, you're going to want to sell at the exact wrong time. And that'll, be a lifetime of trying to recover from that loss you took. So Charlie Munger, he just, may rest in peace, just died 2 days ago. And we practiced this presentation 2 days ago. And I'm going through this, and Tim was listening in. And apparently on his computer, he looked up Charlie Munger to get some more data on him. And he says, oh, Charlie Munger's 99 years old. He's going to be 100 years old on January 1st. And we're like, holy cow. I said, wow, we better finish this presentation really quickly because he could die any moment. And of course, he died that afternoon, which is sad. But anyway, I don't think I had anything to do with that. But it was just remarkable. He was a remarkable investor, and this is absolutely true. And that is part of the reason why we preach diversification. While it's very tempting to want to be in whatever's winning at the moment, dealing with those big declines is very difficult. And the most important thing is to be able to get to the other side to enjoy the returns over time. So by being diversified, it's easier to handle those 50% declines. Okay, thank you, Charlie. Next slide. Okay, key takeaways. This is kind of hearkening back to some of those key points I said early on. The shares of even America's finest companies have experienced frequent declines in price. Some of these declines, driven by very real crises, real events, have been quite significant. And despite these setbacks, leading U.S. companies and really leading companies around the world have continued to grow their earnings, continue to grow their dividends very strongly over time. And their shares have overcome even the deepest declines more rapidly than one might expect, and they've gone on to new heights time and time again. So, next slide. So a little compliance thrown into here. Past performance is no guarantee of future results. The choice is always ours. We can say this time it's different and make a big change in our portfolio, or we can say this too shall pass. And we're going to be here saying always, this too shall pass, and helping you understand why that's important when these things happen. So that is the presentation. I'm hoping maybe one or two of you may have a question or two, or possibly a little comment from the peanut gallery, possibly, if you're my brother. Okay, I'm going to turn on my camera so you can see me as I answer your questions. And Tim and Dan, if you would open everybody's audio, I'd appreciate it.
Well, Mark, I feel like you set me up. I need to say anything. I just want to say that I was smiling through the presentation because probably like a few of your clients, that they may be more calm than I am. They don't bother you as much as I do. But I was just smiling at all the reminders you've given me over the years, and actually as late as a couple of hours ago. So I appreciate it. And I'm not one to argue with the numbers, but I'm a little older than you, so I remember definitely all three of those big downturns. And yeah, it's come back. Some very interesting data. Thank you.
Great. Thank you for being so kind to me in your comments.
Yeah, don't get used to it. Yeah.
Thanks. Okay. Anybody else? Okay, and please reach out to me in coming days if you want. And I want to end this with one last thing from I prepared one last thing, and here we go. In the land where markets dance and soar lies Santa Claus, a shrewd rapport. With twinkling eyes and stocks aglow, he invests in dreams that futures sow. His workshop hums with bustling glee, crafting plans for each company. In stocks he finds a merry chance to grow his wealth to enhance. He checks his list both twice and thrice, picking assets, oh so wise. For Santa knows in bull or bear, investing's more than gifts to share. With dividends like snowflakes fall, he watches portfolios stand tall. In every trade he finds delight, guiding his sleigh through day and night. In this Yuletide, let's learn and see investing magic just like he, with vision bright and patience true. May your ventures flourish anew. For like old Santa's timeless cheer, investing brings a brand new year. So let's embrace the market's claws and celebrate like Santa Claus. Happy holidays, everyone, and thank you for listening.